What's up, guys? Welcome to another episode of Trade Stock. I'm super excited for today's conversation with Nick Bartolo. He is coming in from an investment perspective. He's in the trades. He's helping people make a lot of money, save on taxes, exit with more money, live the life of their dreams. I'm going to let him speak for himself on that side of things. But Nick, welcome to the podcast, man.
Hey, Justin, what's going on? Those are some kind words from you, but it's awesome to be here. And it was great seeing you last week, I guess it was, in Phoenix at Elevate.
Yeah, man, that was a great show. It was just a reminder of just how fast this industry is growing, changing, exploding. You got into the trades industry, I don't want to say recently, but somewhat recently. You spent a number of years on Wall Street and working in that sector. Would love just right off the bat, give our listeners a bit of a background of you and where you came from and what you're doing today.
Yeah, thanks. Yeah. I mean, shoot, I wish I would have started a lawn and landscape business back when I was 21. I can tell you that. But I had no
Seriously.
clue, and I wasn't smart enough to do that at that time. But I won't take you back to birth here, but I will give you a little perspective because I do think it's important to kind of know where I came from. So I grew up in Las Vegas, right? And if anyone who knows anything about Vegas, it's been one of the fastest growing cities in the country for the past 40 years. And obviously with that growth comes a lot of growth in construction, landscape, building pools, pest control, roofing, all of these things that my friends, either started those businesses or their parents had those types of businesses growing up. And my dad used to even build pools on the side from his, normal
Nice.
high school teaching gig. Okay. And so I grew up around the trades. And then, as I mentioned, I didn't go that route because my parents were on me with the grades and education, which is, a smart thing to do with your kids by and large, I think. Not for everybody, but I took a much more kind of technical route over time, and that went to undergrad at USC, got my CPA, majored in accounting and all of that. And so while I'm in wealth management now and I have my own firm, Essential Partners, most folks in wealth management go the sales route. And there's nothing against the sales route by any means. As you know, sales is business. And eventually, if you don't have good sales, you don't have good marketing, you don't have a business, okay? But coming out of undergrad or even coming out of grad school, I wasn't really interested in, I guess, going that more sales route. So I took the technical route, did the CPA, and then really during what I call the OG tech bubble back in 99, 2000, I just became fascinated with investing, okay? So I know there's a lot of guys and gals out there that got into investing in stocks during COVID. That was me, but 20 years prior. Okay. So once I did that, I heard and I figured out that you could actually have a career investing in stocks and bonds. And I was all in. Okay. So I went to work, I studied, read all the books, and then I went back and got my MBA back again at USC down here in Southern California. And then somehow convinced a large money management firm to give me a job where I basically got to go around the world, meet with Fortune 500 CEOs and CFOs to dig into their business, okay? Not to necessarily sell them anything, but just understand their business, model out the financials, study transactions in their industries and on their type of business, all over the world to try to make a decision on whether or not we should actually invest in those companies. Okay. And those investments were being made, and I was helping to manage money for large institutions. So we're talking about big pensions, endowments, mutual funds, those types of large pools of capital. Okay. And that sort of gave me that foundational investing experience where I then felt that I had that expertise where I could look across the table from, a 55-year-old person and say, you know what, you just built your business, you sold it for 50 million. But I've had this experience where now I can steward that capital for you and your family into the future. So you not only protect that wealth, but you grow it over time in a tax efficient way. Okay. So it's kind of a long-winded answer, Justin, but
No,
that's sort of what I've been up to over the past 25 years, I would say, where I, started very technical, and now I have my own firm, Essential Partners, bringing that investment knowledge and tax expertise to families in the trades.
Fantastic. And I think the marrying of those two backgrounds, the technical aspect of the CPA and the business acumen of the MBA, and then also spending time inside those companies, has probably given you a very unique look at how business decisions are made, both investments within, such as CapEx or greenfielding new markets or going after new product lines, versus maybe acquiring that new product line or acquiring a potential competitor that's springing a new product into a market. And obviously I'm talking much bigger than just the trades here. I'm talking about large, Fortune 50 companies. How has those decisions, being that close inside of those businesses and trying to steward and, in a way, guide the money flow, the invested capital into these businesses at the right time, at the right place, what was one of the biggest lessons you took back from that experience in terms of, and I want to kind of give you a little bit of specificity to answer the question because this is very broad, but like a lesson through that process that helps you today with when to invest in a business and when maybe not to invest in a business?
No, that's a good question and good kind of background perspective. So before I started Essential Partners, I kind of viewed myself as a professional critic in some ways, right? So I would do a bunch of work. I would analyze the historical financials of a company. I would analyze management's decisions on how they allocated capital. So if they decided with their free cash flow that they were generating to go ahead and invest in a new capital project to expand capacity in some jurisdiction, for instance, or alternatively, they could increase their dividends and pay that money back to the shareholders. No different than, if you decide to take money out of your business to fund your life or save or whatever you want to do with that, right? So the parallels are there between private, closely held businesses and also large public companies.
Yeah.
In
we
addition,
would kind of look at that in just like kind of like everyday business speak, maybe like retained earnings on a balance sheet. Are you retaining your earnings? And then versus maybe distributions or shareholder draws on a balance sheet for those small businesses, kind of trying to apply their methodology to the bigger companies.
Right. Exactly. Same concept, slightly different terms. Okay.
Awesome.
The other use of capital and another takeaway would be whether or not these companies have made acquisitions and what ended up being the result of those acquisitions. So it's very easy in public markets to be able to look at an acquisition, figure out what they acquired, how much they paid for that, and then what were the valuation multiples. So did they pay 5 times EBITDA or cash flow, or did they pay 20 times? And then how did that compare to other acquisitions in similar businesses? And what was the end result of that? So did that business actually end up being integrated well with their existing business? Did it lead to cost synergies? Did it lead to new revenue opportunities? So I guess the parallel to your business would be, I have a big, let's say, commercial maintenance business, but I don't really have the capabilities necessarily to do commercial new builds. So if I acquire a competitor in my area at an attractive valuation, now I acquired all the people, the equipment, the know-how, the relationships to be able to now do commercial new builds, which will then go and feed my commercial maintenance business in a synergistic fashion. Okay.
Right.
And so then you could look at something like that and say, hey, you know what? That actually allowed our commercial new build business to take off, which fueled our commercial maintenance business. And now we have a much stronger, higher growth enterprise. So the same can be said about investing in public markets and analyzing those acquisitions as well. But to your question, I would say one of the main takeaways was that you have to run the numbers. Okay. So a lot of folks, particularly on the small business side, they have brilliant, grand ideas and good strategic plans about what they want to do. But the analytics on the quantitative side might not always be the basis of their decision making. Okay. So the takeaway from my time, as a 17-year public markets investor that can be applied to the trades and smaller businesses, not that they're small. I mean, we have these 100, 200, $300 million transactions taking place. But the takeaway would be, no matter what you're doing, whether it's M&A, whether it's investing in a new project, or whether it's measuring the underlying aspects of your business strategically, run the numbers in order to have your decision-making be backed by data.
Great insights, because I do think people often will lean towards their emotional side of the decision-making paradox versus focusing on the data, focusing on the numbers. And it's hard. I mean, I can speak from experience.
Sure.
We've looked at acquiring a lot of companies over the last 2 years, and we've been part of our 2025 strategic plan was to buy at least one company. And I literally did everything possible, I think, other than actually just saying, okay, screw it, let's buy, to put myself in the room and look at all those, get into LOIs, get into due diligence. But the data just continued to tell me a different story of, this is not the right purchase at this right time. And there's a lot of reasons behind that. The biggest one, I think, is our organic growth. And we kept turning it down. And here we are. There's no way we're going to close a deal in the next 60 days. And I'm okay with that, because we made our decisions based on data, in spite of having that strategic plan that was like, we're going to buy a company in 25, which I guess I'm a little bit disappointed on one side, but I'm also, I think, from a stewardship of our yeah, exactly. I shouldn't be. I'm taking that away. Yeah.
No, I mean, so Charlie Munger, Warren Buffett's longtime partner at Berkshire Hathaway, the former vice chairman of Berkshire Hathaway, he is fond of saying that at Berkshire Hathaway, they never had any strategic plans. Because if you do have these strategic plans that you think are set in stone, which, in your case, you're talking, you still have this like tinge of disappointment that you didn't do it. But his thought was that if you have these big strategic plans and visions, that those can sort of take on a life of their own. Okay. And it doesn't allow for the flexibility that you need when things change. Okay. So for you, what changed was that you didn't find a deal that would be supported by the numbers where you thought you could generate a good return. And so instead of anchoring yourself to that strategic plan, you pivoted and said, you know what? I may be a little disappointed, but I'm not going to do a bad deal.
Yep.
Which is smart.
Yeah.
Kudos
I appreciate
to
that.
you on that.
Thank you. And actually, we talked about this in Phoenix a couple of weeks ago, or
we did.
I guess that was last week. Geez. And
yeah, that's crazy.
It is. But in a way, I mean, a lot of what if people who are listening to this listen to this often, I do talk a lot about this 10-year plan, having a vision, buying in with your team, getting that alignment, and then charging forward towards that vision. And I think this is such a great, side note of, hey, but be careful. Don't let the vision drive you into bad decision making, or, hey, this environment we're in is changing rapidly. So the strategic plan you created last year may or may not apply to today's business fundamentals that we find ourselves in.
No, it's smart. It's smart to keep that in mind. And it sounds like you are. So that's great. But you're right. Yeah. And especially you, I mean, because you're out there, you're talking about your vision, which I think is also extremely valuable and important, especially as a leader, to set that vision for the entire organization. And so it does make it more difficult, though, when it's out there and everybody knows, to be able to pivot, right? But that's no different than a public company CEO. They're out there on their quarterly calls every quarter talking about that, and they still have to have the flexibility to pivot as well. So it's really no different than them, but it does make it a little more challenging. But now you're aware, and it sounds like you've been aware.
Well, I'm learning and I'm picking up notes, but I do think it's a good note for the audience of, like, have a vision and be willing to pivot. It's just like no different. And I feel like this is an overused analogy, but if you're driving across the country using maps and you get to a road and it's closed or it's flooded and the map on your GPS is saying to go through this road, you don't just go through anyway. You're like, I'm going to find another route around, even if your initial plan was to go that way. And so I think you can use that same thing in business. If you get to that destination or on the way, that milestone, should I say, and the road's flooded, like, don't risk it. Go around, find a different way. And then over communicate that. If you're a big communicator on vision and you're going to change it, communicate that. And I think that's a hard thing for CEOs to do. It's hard for me to do, is when you've been so vocal about a vision, to go back to your team and be like, hey guys, I messed that up. We were pivoting. This is the direction we're going in. This is why. The why, I think, is important, and then charge forward with absolute certainty.
And what you're saying, that builds trust with your team and any stakeholder. Like when you let the data, you let the analysis guide your pivot and guide your new change of direction, your team is then has a higher degree of trust in you as a leader, as opposed to just putting the blinders on, right? Like the other thing that's important, in my opinion, and I'm not trying to pontificate here, like I'm the business expert in running these businesses. I mean, I run my own wealth management business, not a lawn and landscape business, but by building that trust with your team, it allows them to bring problems to you more rapidly. The worst is that if you have blinders on, you're following the strategic vision, and your team is timid and they don't want to bring you the problems. Then you have a bigger issue, right? Yeah.
That is the worst. And I know people that I think fall into that category where they create such an environment of success that the team is so nervous and afraid to fail. And we talked about this again. Elevate had so many great conversations, but one of the questions I got on my talk was, how do you handle all the failures? If you're going to try 1,000 experiments, how do you handle the 950 that don't go right? Like, well, you tell everybody that they're going to fail and be like, we're going to fail a lot. And every failure is a celebration that we're that much closer to the next iteration of this plan. And Elon Musk is really good at this when his rockets explode or unplanned rapid decompression or whatever he calls them. But it's like, he's like, no, we learned so much in that failure, and we're going to make the next rocket better.
Yeah, exactly.
So Nick, I want to ask you a little bit about how did you get into the trades initially? So you're working with these big companies, stewarding this money, and you started your firm that you run today. Was that your entry into the trades when you started the firm, or when did you actually start working with trade businesses?
Yeah, I wish I would have gone right into it, but I did get lucky. Okay, so since I started off as a CPA, I had some long time relationships with folks I worked with, back 25 years ago during my CPA days. And one of my close friends from that time owns a CPA firm, and he started referring me some business. And it just so happened that the first person he referred me to owns like a top 25 pest control company in the US. Okay. And so my first client was someone, I consider that the trades, right? A big pest control company.
Yeah.
Unfortunately, I did not have the insight at that time to just go all in on pest control, lawn and landscape, roofing, etc. I went and I floundered around for a little more and tried to, build other relationships, get other referrals, that sort of thing. But then when I took a step back, I think like many entrepreneurs and business owners do, and I thought about how I wanted to grow the business over the next 5 to 10 years, I looked at my current clients and I thought, hey, I had a couple pest control clients at that time. I had one lawn and landscape client at that time. And I said, you know what? Like the people I actually enjoy working with the most is this group of people. And the people I think my skill set, basically, let me strike that for a second.
No, you're good.
Okay. So when I looked at the people that I enjoyed working with the most, it was the clients that I had that had trades businesses. And then when I thought about which services that I wanted to provide on a recurring basis to my clients, it was folks that were likely to sell their business at some point. And again, this is just marrying my background of being a business and financial analyst first, having an acute sense of how to mitigate taxes before a sale, during a business sale, and then on investments after a sale. And also just my background in Las Vegas and being around these types of folks that had these businesses, those are people that I liked working with. Okay. And I think it's also a group of people that are humble enough to understand that they may not be the investment experts. They may not be the tax experts. And so they're seeking help from people that are no different than me thinking that I could run a lawn and landscape business. I can't. I'm very comfortable with that, and I know my lane. Okay. And so that's how I happened to start working with folks in the trades, is that I finally decided, like, you know what, like I'm going to actually just focus on these industries, and started developing relationships with different people in the industry in order to kind of scale up my business in those trades areas, particularly people that either have big businesses that are growing and are likely to exit at some point.
Awesome. I think that's a great way to fall into it. And I'm just, thanks for joining the trades. I mean, we talk, I think we're all super lucky, and we talk about this a lot, but we talk about the fact that the trades are it is an industry that is bringing in some of the best people around the world right now because of a lot of reasons. There's a lot of reasons, but really it's this large amount of wealth creation that's being built through these much larger businesses that have ever been created. And it's folks like yourself and others who are joining the trades who think, hey, this is really a place I want to actually niche into. And you had so many different ways you can go with your firm. Choosing the trades is just such an awesome example of why I think this industry is in the best position it's ever been in. Now, when we talk about helping business owners, create wealth during their management of a company, they're running the company pre-sale, and then they sell the company, being smart with taxes, exiting in a really positive way and a meaningful intentionality way, and then post-sale, making money on your money. I mean, that's like, I think the $1 million question everyone wants to know is like, well, we always hear of how people make money with their money or OPM, other people's money, all that stuff that people talk about. I'd love to unpack, what does your firm do for business owners who are, maybe will start at that pre-sale, before you sell the business as you're still running it?
Yeah. So there are, as you point out, Justin, there are, I would say, 3 dimensions of this process. And, we have a framework for it. It's called the Essential Exit Framework, after the firm Essential Partners. Okay. Nice. And this framework basically encapsulates pre-sale, during the sale, and then after the sale, as you point out. And I do think that it's really important for business owners to think about this process, because especially for those that aren't having a $100 million exit, you really have to ask yourself the question, how do I know how much I need to sell my business for if I don't know how much tax I'm going to pay on the sale, and I don't know how I'm going to invest the money after the sale, and also how much tax I'm going to pay on the investment income I'm generating from those investments. Okay. So it's hard for me to comprehend that, because if you don't know that, how can you go into a transaction where you're like, okay, I'm going to sell my business for 10 million bucks, and I just know 10 million's always been my number and I'm going to be good. Okay. Meanwhile, you may be spending $600,000, $700,000, and you're running a couple $100,000s through your business income statement. Okay. So your financial situation becomes much more hard to calibrate. It's harder to not pay a full tax rate on the money that you're generating. And in that instance I gave you, you're probably going to run out of money. Okay. Yeah. And so what happens is that what people end up doing is they have that number, they sell for that number. And then, since they don't necessarily have the familiarity with all of the investment options that are available to them, because why would they, right? It's not what they're doing all day, every day. What they end up doing is they say, hey, you know what? I know real estate. Like, I see a building over there. I see a multifamily apartment complex over there. I'm going to start buying real estate. Okay. Because also, real estate's been one of the best investments you can make over the past 40 years. And today, though, and I'm not here to, talk down on real estate or say that's a bad investment. I think it should be part of the mix, but that's unlikely to be able to support you and your family, because the real estate cash flow properties today are very different than they were 30 or 40 years ago, as interest rates have come down from 20% in 1981 to 0 in 2021, and now back up a bit. Okay. So that's caused a huge appreciation of real estate. And so that investment opportunity might be the same as it was historically. But to back up, because that's a bit of a tangent, So to back up, what we really help folks do is think about the timing of their sale and the value of their business, and then weave that thread and connect it to the sale, how much tax they're going to pay on the sale, how much money we can save them on the taxes on the sale, which can be 20% or more, and then how they're going to invest afterwards on a tax efficient basis to fund their lifestyle. Okay. And that's the framework, the essential exit framework. Pre-sale decision, taxes on the sale, investments and tax mitigation after the sale. So let me give you an example.
Yep.
If you think about take your business, all right? You think about your business today. What we do is we model out the financials at a high level over the next 3 to 5 years or potentially longer, right? You mentioned you had a 10-year plan.
Yep.
So what we'll do is we'll do revenue growth and different iterations of what that growth might be. We'll do EBITDA margins or cash flow margins and how that could be variable over time given your business mix. And then the ultimate, or one of the other ultimate metrics is valuation multiples. So if you sell in 3 years, what is the valuation multiple likely to be on that EBITDA that we've projected? What is it likely to look like in 5 years or 10 years versus today? And when you have this built out, then you can actually run multiple scenarios on what if the valuation multiple goes from 12 times EBITDA to 8 times EBITDA, right? Mm-hmm. No one truly knows what it's going to look like in 5 years. Everybody thinks they know because multiples have been on this upward path over the last 10 to 15 years. But keep in mind, we're all familiar with Microsoft, right? Yep. So Microsoft for 3 years traded at less than 8 times EBITDA. Wow. So if we were to sit here and say that a lawn and landscape business can't trade at 8 times EBITDA again, I think we're just being foolish and overly optimistic. Okay. So preparing owners for different possibilities and what their business exit might look like on a value perspective, I think just emotionally, psychologically, and financially is really important. Okay. Because what you sell for and when you actually transact, that's going to have a huge influence on how you're going to be able to fund your lifestyle in the future. Okay. I mean, look, guys can run their business. They can hit numbers. They can grow for 5 years. Multiples go down. You end up selling for the same amount you could have sold for next year. And so that's a big piece of the analysis.
And that can happen. I mean, I agree. I think multiples are on the rise. They've been on the rise, but there's corrections and there's cycles to all of this. And we don't know what the correction is going to look like or the cycle, but you want to prepare for whatever situation that you're going to face, because as you're saying, you're working with people who maybe they're not in the place in life where they want to go and restart from zero, or they want to run out of money. They don't want to run out of money. That's like worst case scenario. But we all know, people listening to this, you and I, we probably all have someone we know or have talked to or heard of that has had that happen. And now they're re-entering the workforce as maybe an employee, maybe a new business owner, but either way, it's like you want to start and go do your second or third act as a way of giving back and creating impact and connection, and doing it because you want to do it, not because you have this giant, living expense that you have to keep up with. And things change, things get more expensive in the future. So I want to kind of dive in. Yeah, go ahead.
I was just going to say the other piece of this analysis that I think is important, particularly as private equity has become so much larger in terms of acquisition activity, is helping folks process the decision of rolling equity, meaning taking an ownership stake in the private equity backed company that's acquiring them, which is typically the case in private equity transactions. So you can understand, okay, if I take 70% of the cash up front in this transaction and I roll 30% in the equity of the company that acquired me, can we now go through scenarios on what the appreciation could be on that 30% that I rolled, and what is that likely to look like in the future, and how can I apply that to my personal life? Okay. And there's also a number of tax strategies that if you do roll equity, you can be far more tax efficient on that future gain you're likely to have on the rolled equity component. Okay. Meaning if you roll 30% equity, that triples or that, quadruples, what is that going to look like at what point in the future? And how much tax are you going to pay on that? Or how much tax can you reduce? So that's also part of the analysis. And it's also a piece of the analysis where, I have a lot of friends that are brokers and all that, but like they're not helping them necessarily with that piece of the analysis. And so I think it's an important, again, back to running the numbers, being quantitative. I think it's an important piece.
I'd agree. I think most of the focus of a broker is primarily to get the largest valuation, to get the EBITDA or whatever the valuation tool is to the highest level. And if you're listening to this and you're not sure what that weird word is, it's earnings before interest, tax, depreciation, and amortization. It's basically your net. Yeah, I always forget. It's like, it's your net profit that you see on your P&L, and then add back in your depreciable assets and the interest you pay to your bank or on other capital expenditures that you may have. What I say, a good rule of thumb for most service-based businesses, it's typically a 2 to 3% pickup from your net profit on your P&L, depending on how you do your depreciation. If you're straight line depreciation, or you're taking your Section 179 and just copy paste, which usually isn't the case. You don't want to really do that, but this isn't a CP. Nick, I'll have you back for a CPA.
Hey, we're dropping tax codes here. Okay, I love
it. I know just enough to get me in trouble. So all these disclaimers on the screen as we speak.
None of this is tax or investment advice.
Zero advice here. We'll put that in the show notes. So I want to say though, and ask you this question: most brokers, most people that are helping folks sell, are focused, and rightly so, focused on getting that EBITDA as high as possible and getting that valuation as high as possible. Now, the challenge that you're pointing to is, well, what do you do about the tax implications? Or should you be rolling 30%, or should you be rolling 5%, or 49%, as much as they'll let you roll? Mm-hmm. Where are they in their investment thesis or the fund's life cycle? Is this a quick 2 to 3 year cycle, or is this a 7-year cycle? Do you see yourself working for these people for a long period of time? Also, you don't get a pick when they sell. They sell when they're ready to sell. That's why they own 51%, and so on. What specifically are you going through in that framework when you're trying to decide how much should someone roll, how much should someone take out, and what are some of those core pillars that you look at when you're trying to make that decision?
Mm-hmm. Yeah, you touched
on. Tough question, I know.
No, it's good. You touched on several. So I think about it 2 ways. There's a personal component, and then there's just a business component. Okay, so let's start with the business component, and you touched on a few of these. So if you're being acquired by a private equity firm, you should be doing as much diligence on which private equity firm is acquiring you, especially if you're rolling equity into that private equity backed company that's acquiring you. Like, that should be your mission of research, more research than you've ever done on anything in your life. Okay, because you're going to be living with that owner, right? And so some of the components, the key components that can influence how much you're going to roll and who you're going to sell to would be, what is the life cycle of the fund that is acquiring you, right? So a private equity fund, they will have multiple different verticals, let's say, in that fund. They may have a lawn and landscape. They may have a cleaning roll-up. They may have, a roofing roll-up, right? So is that fund new? Meaning, was it launched and the capital was raised in the last year or two? Or is it year 7 of a 10-year fund? That's a very big difference in terms of how much capital or how much growth you could expect from your rolled equity. Okay, so if you are the first lawn and landscape acquisition in a new private equity fund, and you are the platform acquisition, by definition, you're the first, then that is an opportunity to roll a lot of equity into that company that's acquiring you, to then participate for a long duration of time in the growth of that company. So you're getting the expertise of the operating capabilities. You're getting all of the future acquisitions that are likely to be done at much lower valuation multiples, which over time is going to accrue more value to you and the equity that you rolled. That's a very different scenario than where you're the 20th acquisition in year 7 and they're saying you should roll 49%, right? They probably wouldn't say that, to be honest. They'd probably just say, we're not going to roll any because we're so close to exiting anyway that you're not likely to make a whole lot of money from that equity roll. I mean, that would be the honest thing to say anyway, right?
Right. Right.
And so those are sort of the two ends of the spectrum in terms of what type of money you are likely to make if you roll equity based on the characteristics of just the life cycle of the fund and the life cycle of the businesses that are being acquired. Okay. There's also all of the due diligence that you need to do on the private equity firm and potentially the managers that are operating that business that are acquiring you. Okay. There's a whole lot of acquisitions they've likely made over the courses of their careers. And I'm sure that they have a reputation that's been earned one way or another. Okay. And so being able to do that research on that private equity firm, I think is also a key piece. And then there's the personal side. Okay. We mentioned there's the business side and there's the personal side. So on the personal side, sometimes it comes down to just, hey, if I sell for 50 million and, I roll a certain amount, a certain percent, I know that even if that turns to zero, the rolled equity, which is highly, highly unlikely, but I know if that even turns to zero, I'm good. Okay. Mm-hmm. I know because we ran the numbers, we ran the taxes, we ran the investments. I know that with this, let's say 30 million, I know that I can fund my lifestyle, spend $1 million for the rest of my life and have no worries. And my money's likely still going to grow. Okay. And so that's a big piece of the personal component. But what's interesting is that a lot of times when people get to those numbers, they say, well, if I'm going to roll a lot of equity into this private equity backed company, shouldn't I just kind of do it myself and keep going on my own? Because I could grow the business. I'm in control. So why am I going to actually keep a bunch of equity when I could just do it myself? Right. And I see the validity to both arguments, although I am a big believer at some point taking some money off the table and reducing your risk, setting your family up for life, because as excited as we are and as positive as we are about the trades and about the lawn and landscape business, things happen that are out of our control and are unforeseen, which could cause value to be destroyed.
Yeah. I think that always has to be at the back of the mind of protecting yourself, protecting your family. And that's why these decisions are so hard. And I think this is why a lot of people end up making a bit of a hasty decision because it's so overwhelming and there's 10 million on the table. They just say, screw it. It's more money than I've ever seen in my life. I'll figure it out. I'm just going to do it. Or the opposite, which is things are going to get better. Multiples are going to go up. I'm just going to hold out and I'm just going to keep doing what I'm doing. But either of those two scenarios I laid out is lacking in that due diligence, that intentionality that you said. I really love, I'm really connecting with this idea of creating this plan, pre-sale, then how much are we going to sell for? And then, down the road, how much am I going to be able to invest and make money off that sale? Because what it brings to someone is it brings a level of certainty that most businesses in terms of small businesses like ours and so many others have never once had. Most small businesses have never had this plan of a financial exit. It's always I'm going to work hard, and when I'm ready to retire, maybe I'll sell it to my employees. It's kind of I talk to a lot of guys that have this plan today, and I'm like, imagine though, if you had a 3-year or 5-year plan that had you with a really clear exit, you could, and I'm sure you would speak to this a little bit. I'd love to get your take on this, but let's say your number is 10 million and you can start to incentivize your team. Hey guys, if we sell, and maybe this is 3 guys on your 30-person team. Yeah. If we sell for any dollar over 10 million, I'm going to share 5% of that or 10%. I'm going to create a pool, 12%, 10% of that exit over 10 million. The first 10 is mine. I just got to, that's just for what I've done. But if we sell for 15 or 20 million, which is very possible, you guys could be looking at a massive exit here. And I think if anything, that brings that level of certainty. You can start creating incentive programs for your team that help you achieve your goals and maybe a lot more.
I love that. No, I think that that's a great idea. And I do see that. I do see that like somewhat frequently. And I think that that framework also makes a lot of sense, right? Where it's like, we think it could be even, we think the business is worth 10 million, or as you put it, like, we want to sell for at least 10 million. Whatever we can do over that, you're going to have an exit yourself. And anything you can do along those lines to create that ownership mentality in your team, I think is extremely valuable in any business, right? But to go back even further to what you said at the beginning of the conversation there, which was, yeah, people, because they haven't planned it out, they either say like, forget it, I'm just doing it. I have this great offer. These private equity guys came to me. They actually took an interest in me. They like me. They think my business is special. Guess what? You're not special, right? You are to your family, to Justin and I, you're special, right? But like
Super
to
special.
these guys making a financially driven decision because they need to generate returns for their bosses and their shareholders and all that, right? Like that's why they think you're special, because you can help make them money, right? So that's like that one scenario of just like puke the business at whatever these guys tell you it's worth. But the other scenario, as you pointed out, which I think is smart, that happens is that people then just, they hunker down, they hold on to it forever, right? Because in absence of doing the work, running the numbers, that's just stasis takes over and they just continue to do what they're doing, which is fine. That's totally fine. Like I don't have anything against that, but it should always, I think every decision should be an active decision, right? To stay and continue to do what you're doing, or to sell and do it on an analytical basis.
Yeah. And I think when people do make that ultimate decision to sell, it's a lot better to have planned that out than to just wake up one day and be like, all right, we're selling. Because I got a little bit of a funny anecdote. I get, obviously with my brand and stuff, I get so many private equity inbound emails and phone calls. So my rule is like, I'll do one a week. And you would think it's like 52 meetings. Yeah, like there's an endless amount. But 52 45-minute meetings a year is it's like the best education that I've ever signed up for. And the funny story though about being special, right, is like these guys reach out. Obviously, I'm not going to say who it is, and they're want to start a platform, and they're like, "Hey man, like really love what you're doing, all in on your messaging, really think you're the guy." And so, all right, cool, set up a meeting. Typical script. I have Drew reach out to him. We got a meeting scheduled this week, and I get an email this morning from the same group of like, "Hey, love what you're doing, love everything about you. You're just exactly who we're looking for. Would love to set up a meeting with you." And I was like, "Oh, they forgot to turn the CRM off. Shit."
Oh my gosh.
So like,
classic.
Drew, being Drew, he responds to it and then BCCs me, and he's just like, "Hey, I think we're going to cancel that meeting after that email. I don't feel like you guys really have your, shit together." But, it was just such a classic
That's a
moment
great
of
story.
no one's special. And these guys are, trying to do the best they can with the information and the knowledge and the purpose that they've been set out to do, which is they're not they're not hiding this. They are there to deliver a 3 to 5x return to their limited partners who invested and believed in the fund. Not only are you a small part of that fund, but you are a vehicle in that investment journey of those people. And again, that's why we're able to make so much money and exit with huge valuations right now, is because these people want to invest in the trade. So I think some people can be a little bit overly pessimistic about private equity. I like to say, like aggressively neutral, as I like to say. And I think it's good, but it also, you got to remember you're not super special.
Yeah. I mean, even our mutual friend, Mark Bradley, right? So
Yes.
like Mark, it seems like a lot of times, like he has a reputation in the industry for being anti-private equity, right? And if you talk to Mark though, and I don't want to speak for Mark, like Mark has a big enough megaphone. He doesn't need, me out there speaking for Mark, right? But I think Mark, if I had to speak for him, I think his message would be that like, no, private equity is not necessarily good or bad. He just wants people to know what private equity is, right? Both positive and negative. Okay. As opposed to this situation we're describing where I'm so special. They took me out to a steak dinner. They
Yeah.
told me they'd buy me a Rolex when we closed, right? And then just being hoodwinked into doing a deal eyes wide shut, as opposed to, I think, what you and I, what Mark, what anybody who's an advocate for the industry would want is for everybody to get the most money, right? And to go
Yep.
into it eyes wide open, right?
Exactly.
After doing their research. So I think if people can do that, and I think us having conversations like this, talking about it at conferences, I think is an important step for the industry.
It is. And it's this acceleration of investment into the trades and the amount of businesses and the amount of transactions that are happening right now. It's super exciting. And you see it elevate. The M&A panels are loaded with people in the room, standing room only, because for that reason, it's the big conversation that people are having. And so on that note, for people who are listening, who are saying, hey, like, screw that. Like, I'm never selling. I'm holding it down. Like, I'm going to hold the line, GameStop mentality. I don't necessarily think like that's the best strategy. I think that is almost like an excuse to not investigate and see what is actually happening in the world of investments in our industry. So for those who are kind of thinking like, this just really isn't a topic that I'm very interested in, what would you say to someone who's kind of thinking like that? Like, this isn't something I'm ever going to use or do or get involved with, so I'm not going to pay attention to it.
I think like you, I'm a lifelong learner. And I think that I would try to impart some of that mentality on someone that had the attitude that you just described. Because anytime you can learn from someone else and how they're making money, how they're, building more profit so they can pay their people more, which can then fuel further growth, which private equity does. I think that that's something that you can learn from. Okay. The other thing I would say to them is that if you don't want to sell to private equity, cool. Don't sell to private equity. Do 52 meetings a year and learn from private equity. Because what you're doing and what other folks are doing that have that mentality, you're learning what the private equity playbook is. So if you learn what the private equity playbook is, you can go ahead and implement that in your business yourself. That may be being more of a hawk on costs. It may be having better governance in your company and more checks and balances, having more regular reporting and consistent management operating principles to run your business. And guess what? If you reject private equity, fine. But if you learn from private equity and implement that in your business, you're going to make a whole heck of a lot more money over time. Okay. So that's really the what I would impart on that person who has that mentality. And then guess what? Like, things happen and you never know if you're going to be a forced seller. Okay. So you may get hit by a bus and then your family is left with your business. And if you didn't take a page out of the private equity playbook and set your business up for sale, now you're going to sell at a bargain bin valuation as opposed to a premium valuation if you would have followed their playbook. Okay. And that's what private equity wants. They want to acquire the companies that operate in a good industry with underlying secular growth behind it, but maybe they're not optimizing the business the way that private equity would. So if they're acquiring a business that, let's say, has 10% margins and they're paying, 10 times for that. Okay. So they can then turn around and increase the margins to 20 or 25%. And then all of a sudden their multiple just got cut in half that they actually paid for that. So they truly were paying 5 times what a normal level of operating profit or EBITDA would have been. And that's what they want. So take a page out of the private equity playbook, learn about it, run your business in a similar fashion while treating your people well, and good things are likely to happen.
Yeah. I think that's one of the best arguments I've heard on why you should pay attention to this movement and this trend, if you will, because it's not just about us as owners and leaders of businesses, but it's truly about our teams and about our families. And unfortunately, I've heard those stories where, the owner was passed away suddenly. I mean, we go through a lot of stress and things happen, and, you know, you pass away suddenly, and now your family's dealing with so many, you know, not just your loss or their loss of you, but the business and what to do with it. And most businesses, if not managed really closely, probably have like 3 or 4 weeks of cash flow. They if they don't have great systems, they probably have 3 or 4 weeks of like getting by until things start to really erode and erode quickly. And compare that with a business that's super well ran, really in a strong cash position, and is queued up for an exit at any time. GAAP financials, you know, really well done, you know, quarterly and monthly reporting. That business will be so much easier to go through a quick and seamless transition, because if not, and those who have either gone through it or know someone that have gone through it, selling a business is an extremely difficult, lengthy, and exhaustive process if you're the one that's ran that business. Imagine being the spouse or a widow and trying to do that process. I mean, it's, unfortunately, there's people who see those opportunities and they do buy those companies, and hopefully some out of good faith, but unfortunately many not. And like, that's not how you want to leave your legacy. So that's maybe the best argument I've ever heard, is if you don't want to do it for yourself, do it for those who've supported you and continue to support you every day.
Yeah, no, you're right, Justin. It also makes me think of multiples, valuation multiples. I mean, I know it's like an interesting segue going from family to multiples, but I think
talk about it.
Sometimes rejection of the private equity concept and of private equity acquiring businesses and driving efficiency in order to drive profitability, I think can get lost on people's view of multiples. Okay, so let me give you an example. So oftentimes in these industries, you hear about revenue multiples. Am I right? Like, do you hear?
Revenue.
I mean, I hear about revenue multiples all the time.
Revenue and EBITDA. Most people talk about EBITDA multiples, but those are the two numbers that everyone talks about.
Yep. And sometimes though, people get trapped into revenue multiples.
Yeah,
where they're like,
definitely.
hey, I heard you could sell your business for 2 times revenue or 3 times revenue, right? Whereas like kind of the old school mentality was like 1 times revenue, if that, right? Depending on it. And so I think when people focus too much, I'm glad to hear that you're hearing, you know, at least an equal balance between revenue and EBITDA, because if people focus too much on revenue multiples, then they lose the focus on profitability. Okay. So I'll give you a bit of a quantitative example here. So let's say someone thinks 3 times revenue is what they have heard other people are selling their business for. And that's happening, right? That's happening in certain instances.
Especially in home services.
Exactly. So let's say you're a company that does $100 in revenue. Okay. And you think you can get 3 times revenue. That's $300, right? And then we continue the conversation and we say, okay, well, what are your margins? And they're like 10%. Okay, so you have $10 in profitability and you think you're going to get $300 in an acquisition or 30 times EBITDA because you were relying too much on revenue multiples that you've heard about and you weren't focused on driving the profitability of your business. Okay, like we know that that's not happening. Okay, no, you're not getting 30 times EBITDA, right? Versus the other business who might have, let's say, you know, there's some fertilizer and weed control businesses that have 30% margins, right? Yep. And so in that instance, 3 times revenue does make sense because that business is doing $100 in revenue, is doing $30 in profit. So that's a 10 times EBITDA multiple. And I think understanding those relationships between revenue multiples, EBITDA multiples, and profitability is extremely important and should be studied closely. And that's kind of what we do in this possible paths analysis to understand those scenarios and how all of these multiples and profitability relate to one another.
Yeah. I think that's so well said, because a lot of people do focus on top line revenue. It's kind of the question of the week in Phoenix last week. Everyone's like, what's your revenue? What's your service mix? And it's just does it even matter? I mean, we're
here to make money.
We're here to
make money, right?
Let's talk about things that actually matter, because that might be a good opening line, but you know, it's going to get down to brass tacks pretty quick when we talk about exiting. And on that note, let's talk about that a little bit. I mean, when we talk about valuations, no one likes to talk about valuations too much. And I don't want to like pigeonhole us into an area, but when we're talking about valuations, how important are revenue year over year, organic revenue growth when you go to sell? How important is your employee turnover aspect or client turnover? And this gets a little bit into a conversation that we don't need to go too far down. I just want to skim the surface of this. But like when you're talking to owners who are definitely thinking of a sell in mind, and they're wanting to optimize their business for the ultimate valuation and build a business that is, like we're saying, scalable and sellable, what are some of those areas that you would recommend focusing on, whether it's in the last few years or it's going back the last 20 years that you've seen that just good, strong businesses have these fundamental things in place?
That's a really good question. I think the first thing that comes to mind is that regardless of what you're doing in these last year, the last 12 months, the last 24 months, you're not going to fool anybody. Okay? They're going to look back at the operating history of your company and analyze, just like I did with public companies years ago. They're going to analyze what the operating history of your company has been over a longer period of time and what decisions were being made and what that means for your valuation. Okay. So, if you all of a sudden ramped up advertising, you ramped up your sales force, and you accelerated growth from 7% to 15% the year before the sale, and because you cut costs elsewhere in your business, you're able to maintain profitability, they're going to be able to see through that. Okay.
Yeah.
What they want to know are what are the sustainable levels of profitability and growth based on your business model and your business strategies. Okay. And then how does that compare to the industry? And how does that then compare to the broader economy? And that's going to really inform what they're willing to pay for your business. Okay. Ideally, you're going to have the highest growth and the highest margin mix as possible with the most recurring revenue. And that's likely to lead to the highest valuation. Okay. All else equal. But it's going to be a mosaic. Valuation is a mosaic of many different variables: growth, margins, underlying return on the capital investments that you're making is another, recurring revenue, high retention. All of these factors are key attributes to a business that's going to get a premium valuation, as well as size. We didn't talk about size, but clearly a business that's doing, 20 plus million is going to get a more premium valuation. That's one that's doing 2 million.
Yeah. And I think what I'm hearing through that whole thing is, don't wait for the last year to run a strong, healthy, profitable business.
Great takeaway. Yep.
Get after it today. No better time than tomorrow to start working on this. And yeah, like recurring revenue obviously has been the big one that is paying the biggest multiples. It doesn't mean, I've seen some people just blatantly, I think really destroy their businesses going after recurring revenue, because for the last 30 years, they're a construction business. And now they're like, well, we want to sell, so we want to just go all in on recurring, and it's really messy. And I don't know. I think you want to be disciplined in all of these changes that you're making. And I preach a lot about
nothing is the end all be all, right?
Yeah, exactly. You need to be,
Yeah.
So
I mean, we love recurring revenue. Yeah, we love recurring revenue, but there's some big businesses out there acquiring a lot of companies that have a nice balance between 50% construction orientation and 50% maintenance, right? And I think a lot of people will be super happy with that, right?
Exactly.
So
yeah.
Hey,
Nick, I want to ask you about this other question that I had. It's just kind of your investment philosophy and how you go about helping people make money with their money. So we've talked a lot about pre-sale, a little bit about sale valuation. I want to go to that next step of, hey, I exited, or hey, I've done really well and our business is cash flowing 2 or 3 million a year, and I've got some cash. What is your investment philosophy and thesis there? And then how do you help people make money once they do accumulate some level of wealth?
Yeah, that's an interesting question. I think that my industry, the wealth management industry, they sort of make a science over making investment topics sound overly complicated. And they also make a science at the same time of like being non-transparent and not really understanding how anyone gets paid, right? Two of which are both pet peeves of mine. And I think are just like, frankly, unethical in a lot of cases. Okay.
Yeah.
So my goal, and I think it's very different for a business owner in the trades from an investment perspective, is that if you, let's compare and contrast two things. Let's say you have a corporate CEO who's always squirreled away a little money in their 401k. They've invested in public markets and they've become really comfortable with just having a lot of their net worth in public stocks or public bonds. Okay. That's like one psychological perspective. And then there's the other emotional perspective of being someone in the trades that have essentially had all of their net worth in their business in which they've been in control of. And then all of a sudden they sell their business for $40 million. Okay. So like compare and contrast that psychological perspective. Like that's a very different profile. Okay. In that second profile in the trades, you're not going to just go, hey, guess what? I'm going to put 80% of your money in public stocks right off the bat. Right? It makes no sense. Like they're like, what? Like, yeah. And guess what? Guess what's going to happen? We're going to have a COVID-like scenario or a global financial-like scenario. And that 40 million is going to go down 35, 50% right off the bat. That's a bad place to be. Okay. So we don't do that. Yeah. We don't do that. And overall, like we manage portfolios to be less volatile, which we find just really increases peace of mind for business owners that have sold. By just limiting the volatility to the extent that we can of their portfolios. Okay. But to your question, when we think about how we invest someone's money, I think that eliminating this jargon and just talking about the concept in as plain of English as possible is important. Right. So instead of saying, hey, we're going to invest in a low cost ETF that covers the globe, it's like, well, what we're going to do is we're going to buy a fractional interest in the best businesses in the world. Okay. And that's essentially buying something that's a low cost index ETF that invests in all of the businesses in the public stock markets. Okay. Another thing we do is that we loan money to private equity firms as a way to generate income for our clients. And so what that looks like is that, let's say, in 2 years, 3 years, someone were to acquire K&D for $100 million. Okay. And this is important just like for people to know about private equity in general, if you're being acquired by private equity. So let's say a private equity firm acquires K&D as the next big high growth platform, $100 million. They don't just take $100 million from their private equity fund in order to acquire a business. What they do is they'll take $60 million from their fund, and then they'll go and they'll borrow $40 million, right? So there's funds that we can invest in to where we're making those loans, that $40 million that's used to acquire K&D, and we're being compensated anywhere from 9 to 11% in order to do that. Okay, so it's not Nick Bartolo, Essential Partners, going out and analyzing all these businesses and making these loans. It's huge multi-$100 billion money management firms with teams of analysts. They go out, they'll acquire or they'll analyze K&D and say, you know what? We're comfortable loaning $40 million for that transaction because guess what? The private equity firm, they're trying to turn that $100 million acquisition of K&D to $500 million. And so we're only loaning $40 million to that. Okay.
Right.
So we do that, loan money to private equity firms simply.
Yep.
That's one way we help generate income for owners and something that we do in our overall investment approach.
And
we also,
go
ahead.
Real quick,
Yeah,
I want to hit on that. When you do that as a strategy, I'm assuming it's a much less risky strategy than if you were to give the private equity company $1 million to be part of a fund. Less upside in your strategy, but a lot less volatility. Is that correct? Is that kind of why
That's
the debt?
exactly right.
Okay.
That's exactly right.
Cool. I just wanted to clarify that.
Yeah. It's a great point.
Yeah.
That's a great point because you don't have the volatility. You have lower return expectations, whereas a private equity firm, after fees, you're trying to get at least 15% per year. In this, we're talking about 9 to 11, which is still a very good return and a great income replacement for owners that are selling. But yes, lower volatility and lower return expectations versus a private equity fund. Okay.
Awesome. Awesome. Yeah, great.
Another thing we do is that we like to own assets that I say can't be printed, with the analogy being money being printed, right? Given the money supply growth of the US dollar and monetary system and the fiscal irresponsibility of our politicians, we want assets that are denominated in dollars but can't be printed. So gold's been a large investment allocation for our clients over the last number of years. I know it's gotten very popular over the last year or two, but we've been investing in it for much longer than that. Real estate is another one, and overall a broad basket of commodities, oil, wheat, corn, et cetera, because those things are limited in quantity and they can't be printed like the US dollar. Okay.
Yeah.
We'll also do simpler things like loaning money to the US government, right? So having an ultra low risk investment earning 4% has its place in a portfolio, because not only are you getting that 4%, but you can use that investment as dry powder if other investments decline in value. So if the stock market crashes, goes down 30%, we can take money from loaning money to the government, redeploy that into higher returning assets. So that's a bit of a sample. We do it in private funds, we do it in public funds, but the thread that weaves its way through all of these things is tax efficiency. So I don't give a shit what someone is earning on a pre-tax basis, because you can't eat that. You can only eat after tax returns. Okay.
Yeah.
And there's a huge difference between pre-tax and after tax if you have tax strategies and if you don't. Okay. And I just think, like, by and large, the wealth management industry, they don't care about your taxes, right? They're like, sell your business, pay your tax, let the government piss it away, and then we'll manage the money and earn a fee on whatever's left. Okay. And I just think that that's a kind of a substandard way of doing it. Not to take too much of a shot at all of the other wealth managers out there, but I think it's true.
It's fair. I've met with a number of wealth managers over the years, and my good friend Jacob, he also CPA, similar strategy, similar mindset. Like, why does it need to be so complicated? Why can't we be upfront with our fees? Why can't we leverage tax benefits? I mean, I started a Roth IRA when I was like 18, and like I'm so glad I did, because it's like I'm thinking about my taxable rate today versus 20 years ago, and it's a lot higher. And I don't think it's going to go down based on, what we're seeing in DC. So, or God forbid, if you're in California or New York now. I mean, I'm in California.
Why do we live in California again?
I don't know. The weather, it is 78 degrees today in the middle of November. But anyway, go ahead.
I do want to touch on that though, Justin, because it's something that you and I have talked about offline is a way to give back to the industry, right? So, I don't tend to work with folks that, are non-owners in these industries, right? But I do think it's important to educate the owners and to educate everybody in the industry on things that they can do that can have a beneficial long-term impact on their financial life. Because frankly, like, financial literacy in this country is terrible, right? And it's nobody's fault. It's just not built into the education system, which also has its own issues, right? Yeah. So let's just touch on that Roth IRA. And I want to give a quick example, and hopefully this will provide some motivation, which a Roth IRA, as you pointed out, you did it when you started at 18, but you can put $7,000 into a Roth IRA every year. And that $7,000 is after you've already paid tax on that money. Okay. So let's say you're married, you put $7,000 in, your wife can also put $7,000 in. Okay. So that's $14,000 a year. I know that can be a lot of money to a lot of people, but it's also somewhat digestible, right? To a lot of people, it's a little over $1,000 a month. Okay. Total. But if you do that for 25 years and the money grows at just 8%, at the end of that 25 years, you're going to have over $1 million. Okay. So just by doing that $14,000 a year, every year, investing it in an index fund, the S&P 500, after 25 years, you'd be pretty happy that you had over $1 million, which is a great outcome for, the vast majority of people. So
I
all
think,
the owners out there,
yeah.
encourage everybody to do it.
It's such a great example because it's not an ungodly amount of money. I think when you look at your Uber, DoorDash, other convenience factors, Amazon that we have in our
Yeah,
life, and you start
that's a
like,
great point.
I don't even, yeah. Uh, we gotta go through the credit card every month, and I was going, it's that time of the month, and I'm just like, how did where did all this money go? And so it's like, if you'll always spend the money is my philosophy. So when you take the money out, and this is like a profit first methodology from this guy, Mike Michalowicz, but it's like when you take the money out at the beginning of the month and it never hits your bank account, you're okay. You can live off very little. But if all the money comes in and then you have to redeploy it out to your investment vehicles, I think it's a lot harder. So I've done everything possible in our company to create opportunities for our team to invest pre bank account in a way. And this is a little different than a Roth, right? Because you're kind of like tax deductible. The idea is, instead of it hitting your bank account, like it's going straight into your 401k, it's going straight to your medical expense, it's going straight to your HSA or other investment vehicles. And I think that's one small thing people can do is maybe just make that reoccurring transfer once a month. Now, I want to start to kind of bring this in for a landing here, and I think we're gonna have to. I'd love to have you into the disruptor group to do like a course with you that's a little more like X's and O's strategy. But I do want to ask, yeah, let's do that. But I want to ask something. If people are listening to this and at this point, hour in, they're obviously invested. So we got them. We got them in. Nick, I guess what I'm asking is, if someone's listening to this and they're like, man, I really should be working with a guy like Nick, like, what does it take to work with you? I don't expect you to give us all the details and if they need to be accredited or what have you, but like, what's kind of the process that you would go through when it comes to vetting or looking at a new client coming on board with you?
Yeah, no, that's a good question. So the way I think about it is there's a few groups of people that I work with, let's say in lawn and landscape. It's folks that have already sold and have accumulated a certain amount of wealth through that sale, or maybe they haven't sold, but they already have money to manage. Okay. And so that group of people, let's just lump them in one group. And I don't have hard and fast minimums, right? Like I think that's a bad way and a non-flexible way to run a business. But that's like one group of folks. And it's primarily focused on managing the money and mitigating their taxes on either their business income or on their investment income. Okay. Then the other group are people that own businesses and they're likely to sell maybe in a handful of years, let's say 2 to 4 years, or maybe it's game time and they're going to sell in like the next 12 months. All right. And that group of people is really the folks that are key targets for this essential exit framework to be able to understand the dynamics of when to sell their business and what that might look like, cutting taxes on the sale, and then managing the money in an ultra tax efficient way, a tax savings way after the sale. Okay. So if someone has, and this isn't meant to offend anybody, but if someone has like $1 million revenue business that has sort of been flatlining for the past 5 years, that's probably not a great candidate for me and a good fit for my firm to help. Okay. I just can't help that person as much as I can someone that has a bigger business that's growing, that is likely to exit at some point. There's a lot of folks that I know in the trades where they're not a client, but we have a long-term relationship and we talk once a year, twice a year to check in to see where they are. Because if they don't have, significant assets to manage, and I don't feel like I can add a lot of value from what they do have, I don't want to charge them money. Like, why would I do that? Like, if I'm like, Steve Jobs has this quote I love, which is like, all business is adding value to someone else's life, right? And if you add value to someone else's life, that's going to be good for your business. It's going to be good for your team. And ultimately it's going to be good for your family. So if I can add value to someone 2 years out, yeah, I'd love to check in with them, build the relationship, help them any way I can in the time that we have together, but I'm not going to charge them any money for that. Right. So those are kind of the two, I would say, broad classifications of folks that I work with. And, look, we do a lot in the 8 and 9 figure business exit realm, right? But,
Right.
5 to 10, like we can certainly help those folks as well.
Awesome. Well, I wanted to kind of cue that up a little bit, because I think if people are interested in that and are in that ballpark, it's great to think about. Also, I always tell like the young guys, I talked to a guy yesterday, he's 21 years old and his business is doing $1 million, but his goal is to be 100 million in 10 years. And so I think this kind of gives people fire.
Yeah.
I know, I'm like, let's go, man. And motivation. Yeah. It's like, hey, let's get you into the 8 figures, start talking to Nick, start planning the course, because when you have that trajectory and you have that course planned out, I think it just goes so much further. So this has been such a great talk. And I want to ask you, as we end all these episodes, with the trade secret, and I want to ask you for a trade secret if you can. And this is something that you've learned over time, learned through the years, learned maybe through some failures, but is there anything you want to leave our guests with today?
I would say maybe 2 things. The first one being that, like, you may come across various wealth managers or financial advisors. They want you to diversify all of your cash flow into all of their investments. Okay. And I would leave you with this, like, get rich with concentration and stay rich with diversification. So if you have a vibrant, growing, profitable business where you can continue to deploy capital or cash back to investing in that business, don't give a financial advisor a dime. Invest in your business and grow that concentrated asset, because that's how you're going to build wealth for you and your family and your team. Okay. When you exit, I do believe that a key to preserving and growing that wealth over time is diversification. Okay. So that's, I think, an overall theme that I would leave you with. The other trade secret I sort of gave away already, and it's focusing on tax. Okay.
Yeah.
So if you have, let's say, a $40 million business sale in California, you're going to pay, around $13 million in taxes. But if you have the investment tax mitigation tools, I think you could potentially reduce that by $4 million, right? Wow. And so if you have an extra $4 million, that's a 30% reduction. It's not in every instance. It's not for every business sale size, but in that instance, a $40 million deal, if you can save $4 million on taxes, invest that money for 20 years at 8%, now you have 19 million almost. That 4 million turns into 19 million. So when you think about tax mitigation, it's like, keep more money so you can make more money, right?
Yeah.
And to me, that's just not as much of a focus as it needs to be. And these are, whenever I talk about anything, we're talking about blue chip strategies. We're not talking about fake trusts, fake charitable land conservation easements and all this other nonsense. Like these are legitimate strategies. So I guess that's what I would leave you with, the trade secrets. Get rich with concentration, stay rich with diversification, and be mindful of taxes.
It's great advice. And I think the tax element too is one of those where it's another easy thing to just excuse away. Well, everyone pays taxes. It's our duty, but I mean, is 4 million in your bank account going to be spent better than in the government's bank account? I would say yes. So
exactly.
Let's keep our money, guys.
Exactly. And I would encourage everybody too. I mean, I know we had the conversation about sort of the profiles, but anyone has any questions for me at any time, like, the onus is on me, and I really value giving back to an industry. And this industry is such a great, vibrant industry with so many good people. That's what I love about the trades, is that it's a people-based business. So the people that end up being successful in these businesses are typically, great people and people that want to give back to other people. So along that vein, like, I'm happy to do that. So please, if there's any other questions, nothing's too small, feel free to reach out.
What's a good way for people to get a hold of you, Nick?
So the best way to get a hold of me is probably, we're kind of all over the place on YouTube and LinkedIn and Instagram and all these things now, but anyone can email me, nick@essentialp.com. That's ESSENTIAL, P as in partners.com. Feel free.
Awesome. And guys, give Nick a follow on Instagram, YouTube, LinkedIn. He posts stuff. I mean, you're posting stuff more than weekly, a couple times a week, and it's
a couple
great
times a week.
content. So thank you for that. Thank you for what you're doing. Thanks for being on here. Great show, man.
Thanks for tuning in to Trades Talk, where the next generation of disruptors comes to raise the bar. If you got value from today's episode, share it with someone in the trades who's ready to level up. For more tools, insights, and community, follow host Justin White and join the movement at jwhitegroup.com.